It's all about bond yields in our first chat this evening. We're speaking after the increase in policy rates by 25 basis points by the US Federal Reserve. But Fed Chair Jerome Powell also spoke about the fact that the fight against inflation, which is the reason behind the increase in rates and the planned increase in rates going forward, is not going to derail the US economy or its growth prospects in the future. Listen in to what he had to say.
The committee made good progress on a plan for reducing our securities holdings, and we expect to announce the beginning of balance sheet reduction at a coming meeting. In making decisions about interest rates and the balance sheet, we will be mindful of the broader context in markets and in the economy, and we will use our tools to support financial and macroeconomic stability. As we noted in our policy statement, the implications of Russia's invasion of Ukraine for the U.S. economy are highly uncertain. In addition to the direct effects from higher global oil and commodity prices, the invasion and related events may restrain economic activity abroad and further disrupt supply chains, which would create spillovers to the U.S. economy through trade and other channels. The volatility in the financial markets, particularly if sustained, could also act to tighten credit conditions and affect the real economy. Making appropriate monetary policy in this environment requires a recognition that the economy often evolves in unexpected ways. We will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain moment. We are attentive to the risks of potential further upward pressure on inflation and inflation expectations. The committee is determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy.
All right, joining me now to talk about this in more detail is Devang Shah, who is a co-head fixed income at Axis Mutual Fund. Thank you so much, as always, Devang, for joining in. What are your initial reactions? I think broadly, this policy decision by the Fed was in line with expectations of a 25 basis point increase, and the guidance of what will happen in the future is also along expected lines. In fact, if anything, the equity markets have cheered it. What is the picture for the bond markets, not just in the US, but the rest of the world, and here in India included?
So I think you rightly pointed out, I think as expected, the Fed hiked 25 basis, and probably if you look around, the probability of rate hikes just before the Ukraine crisis was as high as probably a 50 basis rate hike in this meeting. So as against that, because of this uncertainty on account of Ukraine crisis, as well as the commodity pressures, you started seeing a lot of increase in oil prices and all, and the impact can be direct and indirect on growth. I think Fed wanted to go slow, and that at 25 basis was very much in prices. In fact, the dot plot, the amount of rate hikes, what they were talking about, including the balance sheet runoff, everything in yesterday's Fed policy was on the expected lines. You see, as you rightly pointed out, the equity markets, the risk-on assets have actually performed very, very good yesterday evening and today morning across most parts of the world. Bond market yields have also remained quite sideways. In fact, US yields, which momentarily touched as high as around 223, 224, are back to now around sub 215. Locally also, I think because it was on expected lines, one event being over the point of time, crude also or Brent prices from its peak of 140 now are sub 100. I think bond traders also are now probably seeing that most of the risk is behind. And for the near term, they don't foresee any kind of risk. Also, the messaging from RBI has been quite clear to continue to remain growth supportive. So locally also, I think bond markets continue to be positive. Yes, it was a mild reaction around 2-3 basis rally, but I think most of the uncertainty and pain which we had seen in yields on local bond yields last fortnight is slightly subsiding, and probably for the next 2 weeks or so, markets will continue to remain well bidded.
Okay. Now, there was also a comment, Devang, on the number of rate hikes that are seen in the future. There are quite a few that are expected in this year itself, and we're likely to see those rates hit 2.8% in 2024, right? So what are the implications of the overall increase in rates?
I think probably what happens is they are given a rate guidance, and as you rightly pointed out, they've not changed anything in the dot plot as compared to what they had published before. So, on a continuous basis, if they expect the inflation for the next 2-3 years to be above 2%, they are going to be on the path of slowly and gradually, once this uncertainty gets over, to be on a hiking mode. I think it will be too early to jump the gun on 2023-24, but I think for the year, probably seven rate hikes, 6 to 7 rate hikes is what has been priced in, and that is all across the curve. You pick up the 2-year US government bonds, you pick up the 5-year, you pick up the short end of the curve, as well as in Indian markets. I think most of the people are pricing in that kind of certainty from Fed, and we don't see Fed moving significantly as what they've been communicated. They have time and again post 2013-14, they have continued to give guidance well in advance and stick to the guidance. At this point of time, our belief is that for the year, most of the rate hikes are in prices.
Okay. Now, the joker in the room, if you can call it that, or the joker in the pack, is what is happening in Ukraine. The Fed chair himself spoke about it, said that the level of uncertainty and the implications for the US market are unknown at this stage. Do you think that that could play spoil sport? He has been very clear in his statement that the US economy can withstand the fight against inflation, that it will stay resilient, it will maintain growth. But do you think that there is a possibility of growth getting substantially hit if this crisis continues?
So, Alex rightly again pointed out, I think probably we'll have to see the longevity of this crisis. Again, secondly, how long this supply, because we are talking about a 6 million barrel supply getting impacted. So how long this supply will get filled into? What kind of steps globally, not only for oil, but for the rest of the other commodities also is being taken across. Inflation is going to be slightly, I think, medium term hit. And if you ask me, for all central bankers, including India, the near term worry as well as for the next 12 months, the worry would be inflation. Also, yes, we have just come out of this COVID impact. I think it is a thin line balance for all central bankers this year, where they have to walk the rope very tightly, where they'll have to manage inflation because of supply side constraints, as well as and continue that the growth doesn't see huge impact. Our view is that yes, oil can be a spoiler on account of Ukraine crisis, but if this problem persists for long, then I think probably the central banker will change its stance or the pace of rate hikes. If it gets resolved in the near term, and we are talking about the next 30 odd days, and the crude prices have actually started showing a lot of resilience, and probably they are seeing that we will see an early settlement. And if that happens, we believe that both Fed rate hike path as well as other central bankers will probably continue to walk this tightrope of managing inflation and growth, and continue to focus on growth as well as along with inflation.
Okay, let's move back to India now. There are a lot of moving parts here as well, and we recently saw the consumer price index print for the month of February come in at 6.07%. Obviously, right. This is to a certain extent reflecting the increase in prices, but then a lot of economists have pointed out that fuel prices have not increased in tandem with global oil prices. So there is a lot of suppressed inflation, one could say. What would you bear in mind in terms of what could potentially happen going forward, at least in the next 3 to 6 months, in terms of inflation, in terms of reaction by the Reserve Bank of India?
So, if you see generally, there is a lot of communication which keeps on coming from various deputy governors, as well as there have been speeches which have been released by where the governor himself has spoken. I think somewhere down the line, what our understanding is $80 per barrel is almost in the projections which RBI is taking. RBI is also cognizant of the fact that at this point of time, yes, there can be some suppressed inflation. But we also need to take into consideration that, yes, that if the oil prices increase for the retail people, there can be an excise cut also, and which can result in probably a net impact of lesser in rupee paisa term as compared to what market is thinking. Secondly, I think what the focus of RBI is that probably what they are worried about at this point of time is the growth sacrifice, which they will have to take into consideration if they continue to remain too hawkish. The messaging from RBI at this point of time is very clear. They would want to focus on growth. They don't want to have a fall into a vicious circle where we have higher inflation, a stagflation kind of an environment. Then we have a problem on the external environment, which impacts currency. So it's a vicious circle. I think RBI what wants to do is continue to have the growth cycle to continue above the median level. And at that point of time, if they have to give us some bit of leeway or relaxation on near-term inflation, I think RBI is okay with it. So our view is that I think that unless and until we have this crude prices, commodity prices, as well as the supply shocks reasonably corrected, I think inflation for the year will settle not at 4.5, probably between 5 to 5.5. But RBI might be okay with that kind of inflation and might not be significantly hawkish. They would continue with a very, very slow and gradual pace of rate hikes.
So, from the macro perspective, Devang, that's all well and good. But if you look at it from the perspective of the investor, this is not very good news, right? Because then real rates are not really cushioning you against the rise in inflation. How should that factor be taken care of? How would you approach the current scenario where rates are not necessarily going up very quickly because growth has to be supported, but yet inflation is staying elevated?
See, from an investor perspective, if you're asking what are the avenues available, I think generally we have seen that a good growth cycle is very, very good for risk on assets. And generally you would want to use equity kind of products at this point of time. From a perspective on how a saver gets saved at this point of time and beat the inflation, I think somewhere down the line, what our projection says is that probable inflation, the headline inflation might be around 5.5, or the end retail investor, what inflation he might face is around close to 5.5, 6%. There are opportunities in both sides of capital market, be it equity and fixed income, which would probably give you those kind of returns and help you across to build a portfolio. In fixed income also, probably there are roll down strategies, target maturity funds, which can be a good solution at this point of time for investors who are passive, who are conservative and don't want to take any kind of huge interest rate as well as credit risks. Similarly, for slightly investors who are slightly okay with, who understands the credit side of the world, I think probably credit funds offer an upward of 6.75, 7% kind of YTM with very, very low durations. So those can be an avenue for investors who understand credit uncertainties. So I think there are options and avenues available in fixed income, which would help you to meet your near-term goals as well as probably try to give you similar returns or beat the inflation expectations.
Okay, leave us with your expectation on the development of the yield curve. Where do you see the yield curve progressing in the context of everything that we've spoken about? Eventually, we are going to see bond yields globally go up, and one would assume that will happen here in India as well. How soon is the question?
See, if you ask me, my understanding is the near term, the next 2 quarters, RBI might choose to be very, very slow and gradual in the rate reversal path. I think probably because crude has settled down, and if we don't see any kind of huge shocks in crude prices, so as you had highlighted that crude is the joker in the pack, I would say yes, I give a lot of weightage to it because it leads to a vulnerability for India at a margin. Macro deteriorates and that impacts the external as well as RBI's thought process. So if crude continues to behave well and below 100, I think RBI in the near term will continue to remain growth supportive, very, very slow in their rate reversal path, and it will guide the markets well in advance. I would say probably in the next 2 policies, we just believe that RBI would change the stance and give a guidance on markets on rate hikes. It's post July where we believe that RBI will start on its rate hike process. And for the year, for the FY23, we believe that RBI will reach around 4.75, 4.5 to 4.75 on the repo rate. My view is probably 4.75 on the repo rate. On a medium term, the terminal rate, what we are pricing in, analyzing the macro environment is close to 5.5. What is the impact of that on the yield curve or the evolution of the yield curve? I think near term, because RBI is slow and gradual, the short end of the curve at around 5.5, which is the 12-18 month assets, makes a lot of sense for investors to stay in the short end of the curve. Post that, I think once the rate hike starts, we will start seeing the curve to get flattened. Today, the spread between 1 year and 10-year corporate bonds, so 1 year CDs are at close to around 5%, 485 to be precise, and 10-year corporate bonds are close to around 7%. So there's a 200 basis spread. I think once the rate hike cycle starts, these spreads will start compressing and a curve flattening theme will work. So the evolution of the curve will be curve flattening once the rate hike starts. Until then, the short end of the curve. How should investors maneuver their portfolio? For the near term, probably they should stay in the short end money market side of the curve. And once the rate hike starts, we have time and again seen that most of the rate hikes get priced in early. The investors, depending on their investment horizon, should start picking up short to medium term funds.
Understood. And you've summed that up incredibly well as always, Devang. Thank you so much for joining in. Always a pleasure speaking with you and look forward to our next chat already.
Thank you. Happy Holi to all.
All right. On that note, we are slipping into a short break. On the other side, we speak about freelancers. Do stay tuned.